Welcome to the PPM Attorney Capital Forum. I'm your host, Darren Mangum, Securities Attorney. I'm the managing partner of the law firm of Mangum and Associates. And of course, we've established these weekly series to dive deeper into a lot of the topics that we usually I've been covering really for the past 10 years on my YouTube channel. We've been doing, I think I've been doing YouTube for the past 10 years, just getting on briefly, 5-10 minutes tops to talk about, kind of highlight high 30,000 foot level topics in the securities law space. The forum is a more in-depth discussion, educating our audience on the ins and outs of securities law, compliance, and in today's topic, and if you're not able to join us live, these are all being recorded, and so if you're a member of the forum, you've got access to the materials, and what we'll try to do is try to send out these outlines maybe ahead of time to subscribers, but we also have just a simple course outline. Today we're talking about sample deal terms and types of securities. There's obviously lots of different, I see a number of people joining us. Thanks for coming, thanks for tuning in. So we're just going to dive right into, we're going to go through the different common types of securities that are offered to investors. And some of the, I guarantee one of these types of securities is probably a better fit for your particular business or your particular company or your particular venture. We're going to cover the most commonly used securities when it comes to raising capital from investors, pooling capital to do a number of different things. In future sessions, we'll get into what, use of proceeds or different rounds like that. But we're just going to talk about the most common types of securities, and that is we're going to talk about common stock, preferred stock, convertible notes, warrants, simple agreement for future equity or SAFE agreements, LLC membership interests, investment contracts, and then limited partnerships. This is not an exhaustive list. There's many other kinds of securities or variations of these, so we'll dive into that. But again, thank you for joining us. Let's talk about the most, I wouldn't say the most common type of security, but maybe the one that most people are familiar with, and that's just simple, straightforward common stock. It's issued by a corporation. So if you're an LLC or you're a limited partnership or you're some other type of entity, you're not going to be issuing common stock. Common stock is limited to corporations. Again, different kinds of corporations. We can get into that in another session. But yeah, the most basic type of security is common stock, and that is basic ownership. Each share of stock is depending on the number of shares that are authorized, the company will start out with a minimum capital, minimum number of shares of authorized capital common stock, or just stock in period, and that is usually designated as common stock unless you have some provisions that we'll talk about preferred stock in a minute. But your most basic level is one share is one vote. Let's say you have a corporation that has 1 million shares. You're going to allocate a number of shares to the founders, and then you're going to have some left over in treasury that you're going to then issue to investors on some terms. And that's a very really common way to offer a company common stock. We're going to offer you 10 cents a share at we're offering 1 million shares for, $1 a share. We're raising $1 million. So you got maybe You've got an example would be like if you got, let's say we have 10 million authorized common shares. Maybe the founders have 5 million or 6 million of that, and then you've got another 4 left over to issue to investors. And so that's how that goes. You can also, obviously increase the authorized capital. A lot of times clients, they'll come to us and say, okay, I already have a corporation, I already have this, I've already issued, myself 1,000 shares, and then we look and we see, oh, there's only 1,000 shares authorized, and you've issued 100% of those shares to yourself. Okay, well, there's nothing wrong with that, but we need to, if we're going to be offering additional capital stock or common shares to the investors, we have to increase the bandwidth of that corporation, and so we have to then authorize. Let's say you're going to raise $1 million and raise another 1 million shares. Well, you're going to need to increase the authorized capital in order to accommodate those investors, and that could be easily done. If you already own 100% of the company, you're just going to authorize. You're going to just do a shareholder resolution and a board of directors resolution to increase the capital stock, and then you're going to then issue those new shares, right? Certainly if you've only issued yourself those initial 1,000 shares and now you're issuing 1 million shares to new investors, well, you're going to dilute yourself right off the bat. So any kind of increase of capital stock that you do certainly needs to be paired with the ability to issue additional shares. You'll do usually like a forward split of like, okay, these 1,000 shares will now become 1 million shares, or these 1,000 shares become more, and then now you're always with a common stock offering, you're always dealing with those numbers of shares authorized, numbers of shares outstanding, and the percentages. It's an easy calculation, but it's something to just always be mindful of. You don't want to issue more than you're authorized. You don't want to issue, if you issue too many shares, maybe you lose voting control. Now the investors have more voting control than you do. So it really does depend on how that's structured. But but common stock offering is very, very straightforward. But yeah, you do have to bear in mind, you always have to be looking at the cap table, making sure that, okay, those are things that are covered. So preferred stock is certainly another class of stock that can be issued to investors, and that is oftentimes issued to investors that are maybe coming in at a later stage. Maybe it's not the seed investors or the founders. Usually the founders are going to be putting in common stock, although you may have a lead investor that may say, hey, I'm willing to put in my money to help you guys get it off the ground, but I want a preferred stock position. What is preferred stock? Well, it means that the investor has a preferred preference or preferred position typically in the case of liquidation. If the company is ever sold, well, who gets paid first? Well, the preferred stockholders get paid first. Or if there's a bankruptcy, okay, well, the creditors get paid, then the preferred shareholders, and then the common, right? Now, common stock, it can be structured in a lot of different ways. They're very, very simple preferred stock, like, oh, well, these preferred shareholders, for example, get maybe a dividend before the common shareholders get any kind of dividend, or maybe they get a fixed rate of return, a fixed dividend, or maybe they just get the first distributions go to them. They have some kind of preference to the common, right? Oftentimes in exchange for that preference, maybe you don't give them voting rights. So say, hey, look, we're going to give you this preferred position, but we're not going to give you voting rights. That would be called a non-voting preferred stock, right? Now, some preferred shares could be structured as voting preferred stock or participating, where they not only have a preference or preferred position, but they also get to participate in any kind of future dividend. They also get to vote, or oftentimes you'll say, okay, hey, we're going to offer you preferred stock, but you can convert it down the road into voting shares if certain things happen, if we hit certain benchmarks, or like if we go public, different things like that. So, example of preferred stock would be, okay, we're going to give you a liquidation preference. We're going to give you an 8% preferred dividend first of any profits, and it could be cumulative or it could be year to year, either way. And also maybe upon conversion, maybe upon sale of the company, it converts on a 2-to-1 basis, right? Or a lot of venture capital companies, a lot of venture capital funds, they'll want to have a preference upon sale of the company. Say, hey, look, we need to get two times our money back or 3 times our money back before any of the common shareholders get paid. I'm not a big fan of that because I've seen it time and time again where entrepreneurs, they're all excited. They're like, oh great, we got Microsoft came and buying us, or Apple or Google is trying to buy us, or they're buying us for $1 billion, or not, maybe not a billion, but several $1 million, and then it turns out because they took this money from the venture capital firm on this preferred stock basis, the venture capital firm is getting paid 2 times, 3 times their initial investment, and then by the time that that eats up all of the profits, and then the common shareholders, the founders that got the thing off the ground in the first place, they wound up maybe with something left over, but they're not going to all of a sudden now retire because okay, great, that would be considered like a base hit, not really a home run, because why? They gave up a big preferred stock position to these investors. And so of course, most of our clients, we're of the opinion that there's no reason why you can't raise capital from investors on your terms, but also keep control of the company, and not be beholden to a venture capital firm. I mean, I'm not knocking venture capital investors, but oftentimes they'll come in and here's the big check. You don't have to go pool it from lots of smaller investors, but it obviously has strings attached. So anyway, so that's just something to keep in mind when it comes to preferred stock. Common stock, preferred stock. We're talking about. Let's talk about convertible notes, or just debt, right? It doesn't have to be convertible. You could certainly do a note. It's just a debt instrument, a promissory note. And so obviously with a promissory note, the key thing is what is the interest rate? What is the term of the note? Is it a 1-year note, 2-year note, 3-year note? Oftentimes we'll structure a PPM where it has multiple classes of notes, where you can issue, hey, if you're putting $100,000, we'll give you, say, an 8% interest rate. And these interest rates are just examples. I know the markets are all over the place, but let's say, hey, you're going to put in $100,000, we'll give you a 8% interest rate. And it's a 1-year note. But hey, if you're willing to give us a 2-year note, we're willing to pay you 10% interest. And if you're willing to give us 3% or a 3-year note, meaning we don't have to pay you back for 3 years, then we'll give you a 12% interest rate, right? And so obviously, from the investor's point of view, they're interested in, oh, okay, that's a great interest rate, but also they're thinking, well, how long is my capital going to be tied up in this note? and obviously what are the risks involved that maybe I won't get repaid back. I mean, the assumption with promissory notes or any sort of notes is that, hey, I'm eventually going to get paid back, even if the company is eventually sold. Okay, well, look, I'm a creditor of the company. I'm at least going to get paid first, and then the preferred shareholders and the common shareholders will get paid. And so, from being but obviously there's no equity, right? I just get my interest and I get my principal back, and that's really it. Sometimes, when we talk about convertible notes, that means, well, hey, if the company's doing really, really well, maybe I can convert my note instead of saying, hey, at the end of the term, pay me back my principal and interest. At the end of the term, or at any point, maybe I can convert. I can say, hey, I want to convert my note into stock, right, into maybe common stock, and so, that could be a certain deal term of the note. And that way, the investor, they say, okay, well, worst case scenario, my note's gonna come due and at the end of the 1 year or maybe 2 years, and then at that point, I'm gonna then get paid back. Or, but hey, if the company looks like it's really gonna take off, it's gonna be awesome, then maybe I'll want to convert and take the upside. So, obviously there's pros and cons. I mean, to the investor, they've got sort of, they got some quote unquote downside protection, and then they have some upside. For the company, notes are always a little bit tricky because sometimes they have a coupon that's payable, like a quarterly coupon that, hey, I'm not just going to wait till the end of the 1 year term or the 2 year term to get paid. It's not like a balloon note, but maybe you've got to make payments to me, every quarter or something like that of my interest, right? Or maybe it's principal and interest, right? And so, depending on the cash flow position of the company, that may or may not be a good thing, right? If you're not cash flowing, and all of a sudden you've got these payments that are coming due, it's going to make things difficult. Or and maybe on a very short-term basis it might make sense, but unless you're cash flowing. I mean, if you're cash flowing, then that's great. I mean, you've got the ability to pay that principal and interest. It's probably way cheaper to do a promissory note type of offering than to give up some equity in the company to just a note investor, right? So anyway, so yeah, I guess the other disadvantage to a company is that those notes always come due. I always say that notes never come due at a convenient time. They always come due when, you're about to make this acquisition, or you're about to, hire these new people, and then, oh crap, I've got these notes that are coming due, and now I got to pay those back, and I'm now not going to have maybe the cash on hand to do certain things, and so. That's certainly something to keep in mind when you're doing a promissory note type offering. Warrants. Warrants. I don't want to spend a whole lot of time on warrants. I mean, they're not super common. I know we said these are the most commonly used. I mean, warrants are sort of what we call sweeteners, where it does give the investor the ability to increase their position. Or to buy future shares, kind of like an option, right? It's like let's say you're gonna buy, hey, you're gonna buy our stock at $1 a share today, but we're also gonna give you these warrants that allow you to buy additional shares at $1 a share, so you lock it in within the next maybe 12 months or 24 months, right? And so those warrants could potentially become very, very valuable if now the company is growing, and now maybe the stock is worth maybe $2, $3 a share, but the investor that got the warrants, that now I can go and buy these warrants at $1 a share still, right? Because that's the strike price that was negotiated, right? So that could be a big windfall for the investor. I mean, it's good for the company too, because now obviously they're not just giving away additional shares. They're actually receiving additional investment, and so the investor has to pay for those. But at the same time, the company's like, well, maybe I'm I could have sold these same shares for $2 a share, $3 a share to a new investor. But obviously a deal's a deal. So we gave you these warrants as a sweetener um, to entice you to invest. And so investors really like warrants. And so I always say, why not? Why not add a reasonable warrant provision onto the investment? It just gives the investor additional opportunity to invest in future rounds at a predetermined price. And so that could be certainly make it a little more attractive. As is the case with all of these type of securities, you really have to keep your ear to the ground when it comes to what's going on in the marketplace. Because obviously investors, they have a lot of different choices. They can choose, lots of different types of investments to invest in. And depending on what interest rates are doing, what's the market doing? What are other companies in your space? How are they raising capital? It's important to stay abreast of these things, which we do. Obviously, we've been doing this for 23 years, and we kind of see what's going on in the market. What was super attractive 6 months ago, a year ago, maybe today because of the markets or what's going on with interest rates or what have you. You sort of have to adjust and pivot a little bit to make sure that your offering is still attractive, is still relevant, and obviously, the valuation, is in line with what a reasonable investor might invest with you with. But anyway, moving on. I see. We've got some questions that I'll cover here at the end. And if we don't get to all your questions, feel free to. I usually like to I try to keep this session to about 45 minutes. And so if we don't get to all your questions, then if you could email that to us, that'd be great, and then we can cover those. So maybe in a future session, or just interact directly. You can always reach out to us directly, and we could schedule a time to hop on a call and cover it. But anyway, one I've got here on the outline, SAFE, a simple agreement for future equity. Again, this is kind of popular in Silicon Valley and in the venture world, startup world, where hey, we don't really know. Basically, it's an investment contract. It's basically saying, it kind of kicks the can down the road when it comes to valuation. Instead of telling the investor, hey, I think my company's worth $1 a share, and I want you to buy it today at $1 a share, it kicks the valuation can down the road and says, hey, I'm not really sure what the company's worth, but we're basically, I need your money today, and then we'll agree to a future valuation of the company, and then your investment contract, this simple agreement for future equity, would then convert into that equity position, like maybe common stock or what have you, right? And so I think it's more advantageous. To me, I'm not a super big fan of it, because it's you might get surprised, right? You might say, okay, well, we're agreeing the value that it definitely rewards the. From an investor standpoint, it's like, hey, if the company is super valuable, then I get a fair deal. If it's not super valuable, then I get a bigger percentage of the company, and maybe I can exert a little more control. But from our client standpoint, it's like, well, you're sort of just kicking the can down the road. I think, to me, it's again, we've set these up, simple agreements for future equity, safe agreements. But to me, I think it makes better sense to say, hey, look, to really make a really good investment case in the beginning as to why you think you're worth $1 a share, and rather than just hope that some future valuation may prove you to be correct, because again, the future valuation may or may not be in your favor, right? And so you might wind up thinking that you only sold maybe 10% of your company, but in reality, maybe you gave up a lot more, right? So, um, anyway, LLC membership interest, very, very common. LLCs are great because they can be structured lots of different ways. We really like LLC interests, and investors like them too because of most of the time an LLC, they're treated as a partnership for tax purposes, and so it's a flow through when it comes to tax benefits, and distributions. You're not, earlier we were talking about like common stock and preferred stock for a corporation, but obviously you got double taxation. You got taxation at the corporate level, and then any kind of dividends, they're also taxed, right? Whereas a LLC interest, it's just a flow through for the most part. I mean, there are LLCs that are taxed as a corporation, but LLC. The nice thing about LLCs is you can structure lots of different equity interests in the LLC that have a lot of the same features that we talked about when we talked about common stock or preferred stock. You can offer units of LLC membership interest, like preferred, voting, non-voting. I mean, a lot of that you can structure it in a lot of different ways in the operating agreement for the LLC. And they really have become, I think, one of the most dominant vehicles for, especially in an early stage company, and you don't really need a corporation, again, for the most part. Sometimes corporation makes sense, but in a lot of cases, an LLC is going to get the job done, and you don't have to worry so much about. I mean, you definitely have to worry about percentage of ownership based on the number of units you're selling, but there's just a little more flexible vehicle to use as opposed to a traditional corporation where you have the board of directors and you got shareholders and all the record keeping that needs to go along with a corporation. LLCs, record keeping, yeah, you still have to keep good records, but that's not as, the structure can be a lot more fluid and friendly, right? I mean, again, LLCs, offerings of LLC membership interest could really be done through any kind of business. Again, you can give up, hey, these units of LLC membership interest are voting, or here these are non-voting. Maybe these have preferred positions or what have you. All the same characteristics that we talked about earlier for that. But so that's LLC membership interest. Investment contracts, as far as investment contracts, I'm a big fan of investment contracts. Because they have really, you can structure an investment contract. Basically, what is an investment contract? Investment contract is basically an agreement that basically says, hey, I'm going to give you money, and then you're going to give me either a percentage of, I may not necessarily get equity position or equity interest in your company. It may not be a promissory note that has a due and payable provision on it, but at some point I'm going to get repaid according to whatever we agree to, right? And so the investment contract could be very, very specific as to a particular asset. We've had clients, like, for example, like a pharmaceutical company. They're like, okay, well, we're not going to give you an ownership interest in the company, but we're going to give you a revenue sharing agreement through an investment contract. Is you're going to help fund this particular drug, FDA trial, for let's say $5 million, and then any kind of future revenue that we generate from this drug, if it's ultimately approved, we're going to share with you, let's say, 50-50. I mean, that would be pretty generous, but we're going to split any kind of profits we generate off this drug 50-50 up until for the next 10 years, right? Or the next 20 years until until you've received, maybe it's not capped. It's just like, it's for the length of the contract, they're going to pay 50% of their profits on this experimental drug that the investor is funding, and maybe it could be like, okay, as far as any kind of or it could be certainly limited, like, okay, until you've received like five times your money, right? And then the contract's done, right? I mean, that would be an example of an investment contract. The investor doesn't really have any equity. It's not really a note, right? Because it's not getting paid back at a certain time, but it's an agreement that basically says you're putting the money in, and we're gonna share it accordingly, right? And a lot of asset purchases are done this way. Oh, in fact, we were talking about safes a few minutes ago. It's really being done a lot with what we call SAFTs, SAFT. That's a simple agreement for future tokens, right? And so, like if you're doing a cryptocurrency offering, 99 times out of 100, you'll be offering a simple agreement for future tokens, which is an investment contract. Basically says, oh, hey, you're going to put in this money, and in the future, at some point, we're going to deliver to you these tokens, these cryptocurrency tokens, and that's the investment contract, and obviously there's securities because you're helping them raise capital for future development of the company and blah blah blah, and so. Anyway, so a lot of cryptocurrencies are structured as investment contracts. So yeah, those are some. I'm really a big fan of investment contracts. They're very, very flexible, and it's sort of this hybrid between, it can have all the hallmarks of equity, sometimes even better than equity from an investor standpoint. And also either debt. I mean, you could structure it in a way that is agreeable to both the investor and the company through an investment contract. The last item we'll talk about is limited partnerships. These are very, very commonly used when we're talking about a private investment fund, whether it's real estate or whether it's any sort of private investment fund, hedge fund, private equity fund. They're all, most of the time they are structured as limited partnerships. With a traditional structure where you have the investors are all limited partners, they're putting in their money, and that's the extent of their liability. But they don't have any kind of voting control. They're just putting in money, and they're limited partners, right? And then you have the general partner who controls it all, runs the show, makes all the decisions, has the ultimate authority to run everything. Obviously, limited partnerships have been around for hundreds and hundreds of years, and they're very, very common. They really, in recent years, have LLCs have kind of supplanted them in a lot of respects, but again, whatever you can do through a limited partnership, you could structure it through an LLC as well. I'm a big fan of doing it through an LLC, but a lot of investors are still accustomed to a limited partnership approach. They just don't have to think about it as much as an LLC. LLC, you've got to dive into the weeds and read that operating agreement and figure out, what am I really buying? Whereas a limited partnership is very, very straightforward for the most part, and you can have different classes of interest in the different classes of limited partnership interest as well with different terms. And so the main thing, I guess the main downside to a limited partnership is that it's the general partner assumes unlimited liability, which is always why you want to have an LLC to act as the general partner for the limited partnership. Never, 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 ever do you want to have a be an individual person be the general partner, because who wants to take on unlimited liability, right? So yeah, so as far as sample deal terms, I mean, most people are familiar with an 80-20 split, like 2% management fee and an 80-20 split, 80% to the limited partners, 20% carried interest for the general partner. I mean, that's very, very common in a private investment fund, but that's I see people do that. Oh, we'll just do 80-20 just because that's what everybody else is doing. But really, you can structure it any different way you can think of. You can do, really, lots of different types of sharing arrangements. You can offer the investors, the limited partners, a preferred return. Hey, we're going to give you limited partners like 8% preferred, and then maybe after that we split it. Maybe after that we split it 70-30 or 50-50, right? It really depends on the economics of the deal. But yeah, anyway, that's limited partnerships. Obviously, from a tax standpoint, same as LLCs, it's a flow-through type treatment, and so any kind of tax benefits or write-offs are passed on through. I mean, obviously there's the passive loss limitations on limited partners. They can only take so much per year of any kind of losses or expenses and things like that. But anyway, but that's a lot of oil and gas deals are still done through these kind of limited partnerships. A lot of private investment funds are still structured as limited partnerships. We do a lot of them all day long. So anyway, but yeah, there's lots of ways to structure that as well. So anyway, I wanted to cover some of these. I've got some background noise going here. Here in Puerto Rico, you get a little of that, people coming by with their boombox and stuff. So got some questions to cover. Sam is asking, should I have a broker dealer or a placement agent involved in my offering, and how much should I pay them? Yeah, that's a great question. As far as involving a broker dealer, do you want to involve a broker dealer? In some cases, when you're raising lots of money, you want to get in front of lots of investors that you don't have a relationship with. A broker dealer is a great way to go. But yeah, as far as most broker dealers are not going to be interested in investing unless they have or they're not going to be involved in selling your offering unless they have at least $25 million or more, and in the offering. Otherwise, it's just probably too small of a deal, right? And so that's something that to keep in mind. Placement agents, they're typically, they could get involved in smaller deals on an individual basis. But how much should you pay them? Typically, broker dealer, placement agent, you're going to look at, maybe 7% on the low end plus a marketing allowance. And then on the high end, it could be as high as, I've seen as high as, when you add it all up, between like the sales commission, maybe a managing broker dealer fee, they'll charge also a marketing allowance, and then administrative. I mean, it could be, I've seen it as high as like 12 to 15% of the offering is all going toward these kind of expenses for the broker, right? So, yeah, I think you just have to be careful. I mean, obviously, you just have to figure it in as a cost of capital, right? So anyway, that's what that is. William here says, hey, what is a competitive interest rate to offer investors right now? Again, that's a great question. Interest rates, I think, your base interest rate, I think is what is like the Fed after their recent increases, I think it's around 6% now, I think. And so, as a rule of thumb, it's like, hey, if investors are like, hey, I need at least, looking at least double that as a competitive interest rate. So I would say, I'd say, a year ago, I would say, 12% would probably be pretty high. But right now, I think that's probably pretty competitive. But again, at the end of the day, you've got to determine what is how long is the term for, what are the, what are payments going to be due, or is it going to be all due at the end of the term? I'd say if it's all accrues at the end of the term, then maybe it might be good, or especially if you have the ability to pay off the note at any time, then certainly, I think on a short-term basis, offering something like 10%, 12% may be attractive right now for investors. But it really depends. Some investors, if you offer them 12%, they just would run for the hills. They'd be super scared about it. So yeah. Okay, Sarah is asking if should I offer a board seat to my investor? Well, I'd say that depends on if they're putting in a sizable amount of money, then let's say your offering is like $10 million and they're putting in half of it. Right now, maybe a board seat might be worth it. If they're just a regular investor, putting in let's say your minimum investment's $10,000, $20,000, $50,000. I would not offer up a board seat unless they're Elon Musk or Warren Buffett, some influential person that is going to be able to connect you to other sources of capital. Then I might offer up a board seat, but ordinarily no. I would not make that as well. You might build that into the offering and say, okay, if you're willing to put in $5 million or more, then we would offer you a board seat. But that's all negotiable, right? So that's all part of that. Anyway, I think that's all the questions we have at the moment. Again, appreciate you guys joining in, and we appreciate you attending the forum. Again, if you weren't able to attend, if you're a member of the forum, then you have access to all of our past recorded sessions. We'll make sure to make this outline available for subscribers as well. And if this is something that is helpful to you, please let us know. And if you find, or if there's other people that that are raising capital that are interested in joining the forum, we do have, please pass them on to us or introduce our website, PPM Attorney Capital Forum.com. And also, before we end, I just wanted to reiterate that we do have a relationship with a capital raising company that deals with not only U.S. investors, but international investors as well. And for people that are members of the forum, paid subscribers, we're, for a limited time, offering them the opportunity to be introduced to them. They have about 32,000 different kinds of investor groups, family offices, angel groups, venture capital firms, just individual, high net worth accredited investors, again, from Asia, from Europe, and also from the United States. And so with that group, if you have your offering PPM all ready to go, then there would be somebody that would probably have a high likelihood of connecting you with the right capital sources to get your deal funded. So again, if you're a member of the forum and a paid subscriber here, then we will be glad to make those introductions. And so anyway, we look forward to seeing you on the next forum next week. And we're talking about. We're going to be talking about, make sure, next week, investor types and where to find them. So we hope to, we'll cover different kinds of investors. I mean, speaking of investors, I just threw out a bunch of names, accredited investors, family offices, where to find them. Well, you could go finding them yourself, but like if you're going fishing, right? Certainly you can go whale hunting and fishing on your own, but it's better to go and get a seasoned guide to show you where they hang out. And so that's really what we'll be covering next time is these different kinds of investors and how to go about approaching them and depending on what you're doing. So anyway, thank you for joining us, and we'll see you on the next forum. Thank you.